Hi guys, this video will be about the Consolidated Statement of Financial Position. Here is the format of the SFP, the Consolidated SFP. This is its basic format. Consolidation will happen when the parent has control over the subsidiary. So the parent is required to prepare an additional balance sheet called the CSFP. This format of the CSFP consists of a few items that you may not have seen before. So first of all, we'll talk about the principles. Consolidation wants you to take 100% of the parent's assets and add it to 100% of the subsidiary's assets. Why 100%? If the parent owns 70% of the subsidiary, then why must the parent consolidate 100% of the subsidiary? We have to apply substance over form. The legal form is that the parent owns 70% of the subsidiary, but the substance is that the parent controls 100% of the subsidiary. And we must always take substance, so therefore we take 100% of the parent's performance and position and add that to 100% of the subsidiary's performance and position. Then we will take 100% of the subsidiary's liability and add it to 100% of the parent's liability. And then the share capital section and the share premium section will be that of the parent only. The reason being is that the consolidated accounts are prepared for the parent shareholders. So the parent shareholders may wish to know how the group is performing. So now, some items such as Goodwill, retained earnings and NCI you may not have seen before. These items are always shown in the Consolidated SFP, and these require very important workings as per the standard. Without doing the specific working, finding or getting the balance sheet to balance will be very hard. So these are key workings that must be prepared when the parent produces the Consolidated SFP. There are some additional adjustments that the parent must do. For example, if you can see property, plant and equipment. The main idea is that you will show 100% of the parent plus 100% of the subsidiary plus or minus any FVA. FVA stands for Fair Value Adjustments. And then if there is any additional depreciation implications to this, this is going to be deducted from the net book value of the property, plant and equipment. Fair value adjustments is discussed in another video. Under current assets, you have inventories, trade receivables, and cash equivalents. These may require adjustments depending on what the intragroup transactions are happening between the parent and the subsidiary. For inventories, you will take 100% of the parent plus 100% of the subsidiary. But then you have an adjustment where you minus something called PUP. PUP stands for the provision of unrealized profits. And then this is deducted when there is something happening between the parent and the subsidiary, and the PUP is discussed in another video. For trade receivables, you can see another adjustment would be where you deduct contras. A contra exists when the parent and the subsidiary owe money to one another. And because we have to eliminate any of these intragroup transactions, a contra is deducted from the trade receivables account. For cash and cash equivalents, we have 100% of the parent's bank balance plus 100% of the subsidiary's bank balance. But there could be another additional adjustment called cash in transit. And cash in transit represents cash floating in the year, which is not yet still in either of the company's bank statements or bank balances, so we just add it back because the substance tells us to add it back. And we'll look at cash in transit in another video. For share capital, right, once again, we show the parent's share capital and the parent's share premium only. Additional adjustments would be if the parent has a share exchange with the subsidiary. That is discussed again in another video. Retained earnings and non-controlling interest, these are key workings discussed on the previous slide. For liabilities, you see, for trade payables, you take 100% of the parent's trade payables and add it to 100% of the subsidiary's trade payables. And again, a contra adjustment should be deducted if needed. And the rest, you just take 100% of the parent plus 100% of the subsidiary. And then, if the adjustments and calculations are properly done, you can get the balance sheet to balance. Additional bits of information required is that the consolidated statement of financial position must show the external investments of the group. If the parent has invested in the subsidiary, the parent's investment will be shown on the parent's individual balance sheets, not on the consolidated balance sheet. The consolidated balance sheet would only show if the parent has invested in any external investments. Moreover, if the parent has promised to pay the subsidiary by the means of a deferred consideration, then deferred consideration is shown under current liabilities on the balance sheet. And once again, we'll talk about deferred consideration in a separate video. And there you have it, guys, the basic format of the Consolidated SFP.